Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Nearly stumbled in that introduction there, which is a bit surprising given I've probably said it hundreds of times. Anyway, let's get into today's Q&A episode. The first question is from Travis. Travis writes, hope you're well. I'm a fairly recent listener to your podcast and really enjoy the insights and practical advice you share. Thanks for putting it out there. You're welcome, Travis, and welcome to the community, if I can call it that. I hope there's plenty of fantastic podcasts to come. In fact, I work hard to make sure that's true. Okay, so Travis writes, my wife and I purchased a one-bedroom apartment off the plan in East Brunswick back in 2013. Unfortunately, it hasn't performed well. We paid $430,000 for it, and based on recent sales in the complex, we would expect it to be worth around $370,000. It's currently rented out for $500 per week, and we started repaying principal interest on the investment loan. In one of your episodes, you were quite bullish on the Melbourne market, including apartments, and I'd love to get your thoughts on whether we should cut our losses or hold for a little bit longer for the hopes of recovery. Also, now that our home loan is essentially paid off, we're wondering whether it's better to direct surplus funds into the investment loan or into ETFs. We're ready to start building a portfolio. We're planning to retire in about 7 years at age 60. Here's a snapshot of our current position. Home's worth 1.3 with 30,000 in the home loan, 90,000 in the offset account, so all since repaid. Super's 880 in combined, direct shares 90,000, investment loan is 430. Any advice or general thoughts would be greatly appreciated. So, Travis, firstly, thanks for the question. Yes, I'm bullish on Melbourne, but it would be actually useful to really think about how a recovery might come about and the order of which a recovery could come about. I guess the first thing I would think about, or the first thing I would say, is that no one really knows. I don't know, and I'm not purporting to be able to have some sort of crystal ball where I can, share some insight. And remember, I'm an evidence-based professional, so, listening to myself, I'd be saying ignore anyone's opinion. But I think with respect to an asset like this, we've got to think about when an asset like this would join in a recovery in the Melbourne market. And, what normally happens is you sort of start to see green shoots of a recovery, and we're starting to see a few of them over the course of 2025, and then it sort of starts to build momentum. But the momentum in a market is pretty weak over the first sort of 1 to 2 years, particularly after a long flat cycle, and particularly after a very long flat cycle with apartments, right? It's going to take a bit to kind of move the market's mindset around these assets. And then it starts to sort of really pick up steam, and that's when you'll start to see it in the results, both firstly probably auction clearance rates, and then obviously growth rates, property growth rates. And it's not until you're deeper into the recovery that an asset's quality becomes less important. So really for an asset like this, which I would regard as not investment grade, new build off the plan, one bedroom, it's going to be almost entirely building value, and they bought it for 430 and it's worth 370 now. That's probably the developer's margin. It's probably really worth 370 when they bought it, not 430, but the developer needs to make some money, of course. And so you really need, for a market to be so buoyant that it ignores those fundamentals, those very weak fundamentals with this asset. So therefore, you've got to make friends to hold it for another 10 years, I think. What you probably won't see is in the early stages of recovery, everything rises. It's unlikely to be the case. What you'll see is really good quality stock benefiting from price appreciation first. So if Travis's goal is to retire in the next 7 years, it's quite possible you could hang on to this asset and for the next 5 still not enjoy any capital growth. I think you should be really focused on putting as much money into super as possible, given you're so close to retirement, 7 years away. And so I would be moving, whether you move the direct shares into super now is, a question for you, and probably really capital gains tax, the type of assets they are. But I note that if you go and sell the investment property, you owe 430 and you'll get 370, but actually it could be worse than that because you might have to pay for, you'll have to pay for selling costs and so forth. So it's really then going to eat into your cash savings. But I just don't think, I can't see an asset like this really recovering. I'm quite negative now on one bedroom apartments homes really since COVID, and greater work from home, those sorts of things, flexibility. So look, the as the saying goes, if you find yourself digging a hole, stop digging. And I think we'd reflect on the decision to purchase this apartment off the plan back in 13. We can classify that as a mistake. So if I've made a mistake, we should course correct. And I just don't think you're likely to see a huge amount of growth. I could have maybe expected at least some growth because of the first home buyer incentives, but there's so much stock like this on the market. Unfortunately, even the good apartments haven't generated much growth over that period of time either. So there's going to be better quality stock vying for, that purchaser. Yeah, I think I just cut my losses and move on. Sorry for the bad news there, Travis, but good luck with everything. Okay, next one is from Harry. Harry writes, big fan, long time listener of the show. Love to get your thoughts on our situation. My wife and I in our early 40s, 2 young kids, 500,000 combined with 2 million in super. Wow. Current property portfolio includes a Brisbane home, 2.5 million unencumbered, a Sunshine Coast beach house, 1.5 unencumbered, and a Brisbane investment property, 1.3 with 900,000 owing. We also hold 400,000 in index ETFs. Harry, so far so good. You're killing it, particularly for your age. You're miles in front, so congratulations. Acknowledge your income is high, but still doing fantastically well. Here's my dilemma. I'm not sure you have one, but here's my dilemma. Both our home and our beach house are investment grade properties that I'd rather not sell. Now, as I suspected, it's not a dilemma. However, we will likely outgrow our current house in the next 5 to 10 years anyway. Teenagers need more space and potentially a third child. So I'm wondering if liquidating them could fund an upgrade into a premium blue chip location, something grand and intergenerational in a trophy suburb in the $4 to $5 million range. I know we're in a good position either way, and much of it comes down to personal life choices, but I'm keen to get your views on the financial and net worth implications to consider. Should we hold our current quality assets or trade up to secure a property in a blue chip location? Okay, Harry, this is a really, really fantastic question. And, the typical sort of approach to investing is no one really knows where the returns are going to come from. So spread your eggs in many baskets. And that's true from an asset class perspective, and then also true from an individual asset perspective. I wrote a blog probably a few years ago now. In fact, I might have a look for it. Okay, there you go. It was more than a few years ago, 2021, start of 21, an investment case for putting all your property eggs in one basket. That's the title of the blog. It would be title of the podcast as well. I don't have an episode number because I weren't using them back then, but it'll be February 21. You'll be able to find it online somewhere. And we were using a different podcast host at that stage, so it doesn't even embed on the website. Anyway, you can read the blog there and the thesis behind it. And essentially, I'm sort of saying is level up on quality. And if I put myself in your shoes, Harry, if I was in your shoes, what would I do? I'd sell the Brisbane home and the Sunshine Coast beach house, and I'd go and buy that $4 to $5 million property. And I say that with a very high level of confidence, like 95, 100%. I've just seen it so many times. I was reading in the paper this weekend that a doctor, medico, sold a Point Piper, I don't know if it's an apartment or a townhouse, I can't remember, I should say, for $32 million. I bet you anything that doctor bought that Point Piper property, probably 40, 50 years ago for not very much and sat on it. And you can easily make the case to say, oh, look, that was then, this is now. It's never going to repeat itself. But except for the fact that people have been saying that for the last 4 or 5 decades. And if it's high quality, it most likely will repeat itself. So I think the growth that you can get from an asset like that will be more than you could ever expect, notwithstanding the lifestyle benefits as well, which I've spoken about previously. And you're in a financial position where it's not going to ruin you either. I mean, you've got the investment property, you've got a very healthy super balance. So even if it goes pear-shaped, you're still going to be okay. And on that basis, that's exactly what I would do. I might have shared this story before, but one of my mentors bought and I won't have these numbers correct, by the way, bought a house in Sydney. It had views of the bridge, I think maybe let's say 13, 15 years ago. I want to say $10 million it cost. It was an investment property, just an investment property. And it's worth 20 to 25 now. There's a lot of those sort of situations where where, quality is key. It's a little bit like pink diamonds versus standard diamonds, white diamonds, I don't know what you call them. The growth in pink diamonds are many times that of normal diamonds. And it's the same sort of idea around property as well. So thanks, Harry. Thanks for your question. I should say this is not advice, particularly when saying to someone they should go and spend 4 to 5 million on a home. Not advice, of course, information only, but based on the information you've told me, if I was in your shoes, that's what I would do. Okay, next question is from Bruno. It's a really long question. Actually, Bruno sent a follow-up email that he sent the question in June, so we might have missed that because I'm answering questions now that we received at the beginning of September. So apologies for that, Bruno. It's a really long question. Bruno and his wife are sort of 36, 38, 2 kids, 170,000 in super, a home, 1.7 with about 700. Well, really net debt's around 500,000. And then 2 investment properties, 700, 750. That's how much they're worth, with about sort of 550 worth of debt each, I should say, based in WA somewhere. And he's wondering about his strategy. Cash flow is pretty tight. Obviously, single income family, kids 3 and 1, with no plans to have any more. So it's a bit of a difficult kind of situation. Look, there's a lot of information here. I don't necessarily want to get into the nitty gritty of it because that's not the point of this podcast. But what I try and do is when I'll see a question, what is the big thing? What's the big thing that this person needs to think about? Or what's the big thing that listeners can sort of take away and apply to their own situation? So the way I see it in this situation is if you don't have a lot of surplus cash flow, surplus investable cash flow, then there's not really much you can do, because you can't really take on additional gearing. And you can't, materialize money from nowhere. So it really does cash flow, or limiting cash flow really does reduce your opportunities. And of course, I mentioned this before, really difficult to continue to aggressively build wealth while you're also building a young family, because as kids are young, they're at home, one parent's only working, expenses are higher, all those sorts of things. We're all been through it. So no need to beat yourself up about it, but it's a difficult thing, and most people are really just in a holding pattern through that period of time. Now, you may recall, I was going to say you will recall, you may recall a few weeks ago, I recorded a podcast called Return on Borrowing Capacity. And that was really just to try and get people to, think really carefully about borrowing capacity, because these 2 properties in Perth look like they're not in the centre of Perth, that they're out of Perth. In fact, I just Googled it, 50 minutes south of Perth. So really outlying suburbs, and one is neutral cash flow, one is slightly negative cash flow, higher rental yields. They're all the attributes of not investment grade assets. If you think about all the attributes of investment grade assets in terms of scarcity, high land value component, and proven performance, I bet if you go and have a look at the performance, I don't care about the performance over the last 2 or 3 years because I know Perth's really kicked off, but let's look at really longer term performance in those locations. What has it been like, for the last 20, 30, 40 years? Now, these properties probably have a reasonable land value component, but I bet most of the overall property's value is in the improvements. And there's no scarcity because, there's an abundant supply of land. And I bet these properties are relatively new builds. So there's certainly no scarcity in terms of architectural style. So there's nothing really, there's nothing really to like about these properties from an investment perspective, in my opinion. Now, they could work just because Perth is in a growth phase. So I'm not saying go and sell them, because if you're in an upward cycle, you may as well enjoy that upward cycle. But I don't see these as properties that I'd keep forever. And because you're in a tight cash flow position, you really got to start thinking about return on borrowing capacity. You've got more than $1 million of borrowing here tied up in 2 assets that, except for maybe the next few years, are unlikely to deliver, good quality returns. And that's the thing that people need to really think super carefully about, particularly if your cash flow position is pretty tight. That is, that if your current gearing levels are eating up most of your surplus cash flow, then you've got to make sure that gearing is allocated towards assets that over the long run are going to generate good, strong compounding capital growth. Remember, that's the whole thing. If we get 7.2% on average each year, our assets double in value. So for Bruno's situation, it's about $1.5 million of property. In 10 years, it should be worth 3. In 20 years, it should be worth 6. Now, will 2 houses be worth $6 million that are 50 minutes out of south of Perth in 30 years' time? I just don't see it. I just don't think that that's going to happen, because what we know is, those cities tend to spread out, and there's nothing that's really unique that's going to keep people to that location. Whereas in Perth, closer to the CBD, the uniqueness is abundant. There's sporting facilities, there's work facilities, they're very close to work, there's a lot of restaurants, amenities, all those sorts of things. You're not going to reproduce that amenity, 50 minutes out of a capital city. So what would I do if I was in Bruno's situation? Because that's what he's really asked. Well, I wouldn't do anything with the property, but I would be of a mind to sell these 2 assets probably in the next 5 years. You don't want to leave it too late. You don't want to sell at the end of the cycle. You just want to sell at the peak. No one knows when the peak's going to be, but I would, if you're still seeing price growth, hang on to them. If you stop seeing price growth, then you might be better off divesting and investing that money elsewhere, as long as you can reborrow that money, right? Because that's the other consideration. And because you don't have any other surplus cash flow, there's not much other advice I can give you until such time, well, maybe the kids are at school, your wife returns to work in some capacity perhaps, and then you've got better surplus cash flow. But that's the whole sort of reason I wrote that episode about return on borrowing capacity. And that's episode 375, by the way. Anyway, thanks very much, Bruno, and all the best. Okay, next question is from a listener who wants to remain anonymous. So here's a snapshot. 28 years old, commercial banker for a major bank. Income's 170 with a bonus of 30 to 70,000 and expects salary to increase. Owns 2 properties, a Canberra unit worth 650, 80% LVR leased to Defence Housing. Was a previous home. Property number 2, Corio in Geelong. 473,000, bought in 2024, bought last year, planned to knock down and rebuild. Other assets, 90,000 in super, 10,000 in ETF portfolio, and investing a small amount of money each month. Lives with partner and splits expenses. The next step at weighing up sort of 2 options: buy a house for about 900,000 in Canberra in ACT. Obviously, this is where this listener is based. And to do that, they'd sell the Canberra unit and the partners unit, and then fund a home to go and buy in Melbourne, because they want to move to Melbourne in 3 to 5 years. So that could be stay in the current unit and buy an investment house in Melbourne. And they want to be in Balwyn, Kew, Camberwell area. And they're leaning towards option 1, which is buy the Canberra property, but they're concerned that Melbourne property prices will outgrow them. And there's a few other thoughts there, but they're probably not that relevant. I mean, the first thing, there's 2 major things here what to do, what this listener should do. But the big one is, oh my God, no one that has any knowledge of Geelong would buy a house in Corio. And I know there's a bunch of buyers agents selling these properties or recommending these properties. Unfortunately, we have a client that is in Sydney that was sold a property in Corio, or could be Norlane, either or, same problem, and sold as a development opportunity. So whoever this listener is, it is the last thing that you want to do is put more capital into this property. You have been sold a dud, most likely. Again, this is information, not advice. I haven't looked at the property, but everything rhymes. I've seen this before. Just be careful about the advice I'm going to talk about all the time on this podcast, that when you engage a buyer's agent, you engage a local area expert. I guarantee that person hasn't been buying property in Corio for a very long time, because if they had if they've been operating in that area for a long time, they'd be stabbed by now, I reckon. Anyway, look, it's not a great location. I grew up in Geelong. That's the last place I'd buy property. And again, I know that a lot of buyers agents are recommending it, but look, you're just making a big mistake. You're paying stamp duty to the Victorian government. They're liable just to waste it on something. And the entry and exit costs are problematic, and you're just never going to get the growth. So perhaps that sort of shows where I'd be heading with this listener's question. But in terms of, what to do, I got 2 observations in terms of what to do coming back to this scenario. The first observation is, to my mind, what I have observed observed in Canberra is apartments really just don't perform very well. Sort of similar-ish story, I guess, to Melbourne. But if you think about Canberra, there's just a lack of density. And so apartments, I think, work really well in very high land value location where it's just too expensive to buy a house. But there's not a lot of density in Canberra. Everyone knows that. And that's probably the reason they don't perform. So if I have a client that wants to buy a property in Canberra, it's always a home. Always want them to buy a home. The thing is, in this situation, if your longer term goal, and remember when in the book Investopoly, I talk about playing the long game, and really what you need to do, regardless of your age, difficult to do when you're 28, I get it, but regardless of your age, you need to start thinking about what is the best decision you can make now so that when you're 38, you look back and go, good on you, that was a great decision. And your big risk is being priced out of the Melbourne market. So I would probably, if I was in your shoes, focus on that acquisition. If you have a high level of confidence that you will want to move to Melbourne in the next 3 to 5 years, and I want to underline high level of confidence. So I'm not going to make a big financial decision like this on, maybe not, a 50-50 proposition. But if you were absolutely in 5 years' time, you said to me, there's a 90% chance we're going to be located in Melbourne, then I'd go buy that Melbourne property. I want to peg to that market because that's your big financial risk, is that the property prices outgrow your capacity, your financial capacity, and outgrow the other assets that you have. But good luck with it. That's how I'd approach this. But just everyone be careful about where you're buying property, the type of property you're buying, because in the long run, it's just not going to work out. Look, I hope it does, but my fear is it won't. Okay, next question is from Andy, who's over on YouTube, posted this as a question on YouTube. And I do answer the questions over there very promptly, but they tend to be easy to answer questions in just a few sentences. Whereas I obviously thought this one was a little bit of a longer-winded one. Andy wants to know, he's currently in Brisbane. He wants to end up in Sydney, wants to be in a particular suburb in the next 5 to 10 years, but his budget is 1.5 to 1.5 to 1.6 million, and that's only going to buy him a townhouse or villa unit in the area that he wants to live in. So would he be better off still doing that and then potentially upgrading in the future? Or would he be better off buying a home in Brisbane and then turn it into an investment property later on? And the way that I would frame this question or describe this question perhaps is, what approach do you take where there's not a clear picture on how you're going to get to where you want to get to? And that's a lot of words that probably, I don't know if I've been very clear. But look, there's been stages, times in my life where I know this is where I want to get to, but it's inconceivable at this stage that I'm ever going to be able to get there. And look, I mean, that could be just sort of limiting beliefs. It could be emotion. It could be lots of different things why that might be the case, but it has happened. And look, I think in those situations, you don't always, this is going to be sort of contradict what I say, you don't always need to have a firm plan. Like if you know what your goal is and you know what you want to get, how to get there, then all you need to do then is make the best possible decision that gives you the highest probability of being in a situation where you can make those goals become true. How they're going to become true doesn't necessarily need to be clear today. You just need to do your best to get yourself into a position to maximize that opportunity or potential outcome. Whereas if it's not true, if it's not conceivable, you can't see how you're going to do it. The wrong approach, in my view, is to say, well, I'm going to just assume that's not doable and then adopt a different approach. And it sounds a little bit sort of flaky, but I've always done that in my life, and I've always ended up kind of where I wanted to end up in terms of achieving those goals, even though when I set the goal, I didn't know how I was going to achieve it. And the way that I did it was really just think really carefully about what is the best thing I can do. So relating it to Andy's situation, the best thing he can do is buy the highest quality asset in the location where he wants to live. That's Sydney. And I would try to employ a strategy that I'm going to talk about next week, being a active property investor or value add property investor. So I'd try and buy some something mostly for land value, something that I can improve down the track that's still tenantable. So you're not going to get a high rental yield, but it's still okay. And it's something that you can add value to if you ever want to, whether that's now, whether it's in the future, whether it's just before you sell the asset, doesn't really matter. Some way that's going to contribute or add to its growth in addition to just general market uplift. So that's what I would do, because that's where you want to be in the long run, is Sydney. If you go and buy in Brisbane, your risk is, that the Brisbane market is closer to the end of a growth cycle than at the beginning. And, you get that mismatch of growth. Whereas, Sydney hasn't grown as fast as Brisbane. So arguably there might be a little bit more upside in Sydney, notwithstanding the geographical benefits that the Sydney market offers. Now, how do you ever sort of get into your forever home? I don't know, but I know the best answer to it is buy the highest quality asset in the location that you're going to live in. And particularly given that this is Sydney and the geographical characteristics of Sydney that are going to drive density and growth, I can't see, to me, that's clearly sort of your best option. So thanks, Andy. Thanks for posting your question over on YouTube, and thanks for the opportunity to answer it here. Okay, next question is from Justin. Justin writes, I recently started listening to your podcast and found it very insightful. Thank you for sharing valuable information. I'm 21 and will be graduating from university end of this year and have found a graduate job earning $72,000 a year. I currently have savings of $110,000, 40 grand in ETFs, 70 grand in savings. Oh my God, I shake my head. When I was finishing uni, I don't think I had $72, not 72,000. So, sorry, that's his income. 110. I didn't have $110. Anyway, it's amazing. I think it's fantastic, that there's so much education out there now that for people that are really motivated to save and build wealth and invest and do all those sorts of things, it's available to them, and they can start very early and learn very early. I think it's a tremendous thing. Anyway, I'm really interested in getting into the property market, but I'm sure about the best path. At the moment, I live with my parents in Sydney. I don't have any plans to move out, and I'm not in a relationship. I wonder if your parents know that you don't have any plans to move out. I've been considering buying a villa unit in Melbourne or a house in Brisbane. That said, part of me wonders whether I should hold off until I can afford an apartment in Sydney or a house near the new airport out west of Sydney. Would you recommend waiting to enter the Sydney market, or do you think it makes more sense to purchase in Melbourne or Brisbane next year to get into the property market? I'm keen to stay at home for as long as I can. If you don't think I should buy property, at what stage, how much salary should I consider getting into the property market? Okay, Justin, it's a great question. Firstly, congratulations on, your savings and investing for a 21-year-old that hasn't even finished uni yet. It's outstanding. So congratulations on that. I guess it's a balance, right? I've seen, and again, I said this the other week, that this is a great opportunity to share experiences, both my personal and professional experiences. And I have seen, many clients, I guess, buy entry-level properties as investments, and then as their financial position strengthens, then they buy higher quality assets. And they're always kind of left with this kind of dud asset. Unfortunately, a lot of them are, investment grade apartments in Melbourne, which haven't performed over the last sort of 13 odd years. So part of it's a timing issue more than anything else. But, the thing is, I've always sort of reflected on, well, maybe we should have waited. Like if we had waited a couple of years and, the client's capacity was a lot stronger, we could have bought a much better quality asset. So a house as opposed to an apartment. I guess in hindsight, it's always difficult. In hindsight, we're always wiser, of course, but I've sort of contemplated that. I wanted to mention it in the answer because I think it's something to really think about. Look, I would say clearly you're obviously good at managing cash flow, because otherwise you wouldn't have the savings. I guess I'd probably like to understand what you think is going to happen to your income, because anyone that sort of graduates in the first, whatever handful of years, income can rise considerably, and therefore your capacity to go and buy property can rise considerably as well. So I'd like to understand what that looks like. But if you expect, say, in 3 to 5 years, your income would be substantially more than your starting sort of graduate salary, then I probably would take the view of, look, keep investing in ETFs in terms of the split that you've got, 40 grand in ETFs, 70 in savings savings. That seems about right to me. Probably wouldn't go much more over 50-50 in terms of investment because you don't have that time frame, but keep investing in ETFs, keep saving and get yourself into a position, if your income is increasing, get yourself into a position where you increase your borrowing capacity. And I'd probably buy the best quality property I can buy in Sydney. That's kind of the approach, as opposed to sort of rushing into the market and then buying a compromised asset. I think in the long run, 5 to 7 years. In 5 to 7 years, you'll be all of, 26, 27, 28. You might look back and go, oh, I rushed into that. I should have waited and got a better quality asset. And that's a learning or observation, I guess, that I can share to try and help you with your decision. Anyway, thanks a lot for your question, Travis, and all the best. You're off to a great start. So I'm sure whatever you do will be a great success. Okay, next one. I'm going to squeeze one more in. It's from Dave. Thanks for the great work you do in educating people financially. Something sorely missed in our education system. I've recommended your podcast to many. Thanks, Dave. I agree. There's a lot missing from our education system, but also equally, there's a lot more available education like this available for free to a lot of people, which I think is a great thing. Anyway, Dave has three-part question. So part one, after restructuring our business, we could buy an investment grade property now in Melbourne for 1.5 to 1.6 million. Or if we wait 6 months with 2/4 of new financials, our capacity rises to 2 million. What's your view on buying sooner at 1.5 versus securing a $2 million asset, knowing that the market may have shifted by then? Okay, so the best, there's that saying, the best time to buy property was yesterday, the best time to buy it was today. But I don't think we should make good quality investment decisions at our own pace without really giving much consideration to the market. Because if we let the market, we can't control, and really what you should have done is bought property 10 years ago, or 20 or 30 years ago, right? So whether you buy today or in 6 months' time isn't going to move the dial. What's going to move the dial is the quality of the asset that you end up buying. And I think if I was in your shoes, I'd wait 6 months and increase my budget to $2 million. I think a $2 million will get you a better quality asset, a materially better quality asset, or a property with fewer compromises than, say, a budget of 1.5 to 1.6. So that's what I do. But also, just for the people out there in terms of setting budgets, understanding what it gets you and how you do that. I mean, it's about finding a great buyer's agent, one that you can absolutely trust. And I've spoken about this many times in the podcast. And then having them show you properties at different price points and getting a better understanding of what makes that asset better. Is it the street within the same, it's just in the same suburb, but better street? Is it more land? Is it a greater living area? What are the attributes? You've got to visualize and you've got to conceptualize what you get at different price points so that you can weigh up the quality of those sorts of assets. And knowing what I know, I'd go for $2 million. But, if you said to me 1.5 versus 1.7, I don't think there's going to be as much difference in something like that. Okay, part two, we're also weighing up not buying property at all, given buying costs, tenant-friendly rules, shifting government policy. Instead, we could gear into shares with portfolio advice and dollar cost average, investing $1 million upfront and adding $60,000 per year in regular savings. This would mean a lower starting point versus buying property, but with holding costs and likely stronger net returns, say 2% above property, plus ongoing savings, would we really be that much worse? Our time frame is 15 to 20 years. We're time poor and prefer hands-off investments. And I should say that Dave did mention that their risk profile is a high risk profile and they're happy with gearing into shares just as much as property. Now, you can be as happy as you like gearing into shares. I would not borrow $1 million and put it into the market, even though I think I could find a home for it in terms of invest it in a way that, avoids the risky parts of the share market at the moment. I'd still be really cautious about that. But what you could do is invest that $1 million over the next 3 or 4 years. And if your time horizon's 15, 20 years, it's not really going to move the dial very much. In between that and now, you could still, because you're only progressively drawing down the loan, it's not going to change that very much. Certainly, investing in shares is a whole lot easier than investing in property. I don't want to overplay it, but you can have a property, you can be a property investor and not have to do anything for 6 to 12 months. And you can be a property investor, and over the next 3 months, you've got to deal with a bunch of different issues with the property. And I think that the time that it takes, if you've got a great managing agent, isn't huge, but it's the emotional labor associated with those sorts of decisions, financial decisions, asset-based decisions, these sorts of things. It can be problematic. You do have more legislative risk with property, land tax, tenant rules, government policy, all those sorts of things. That's certainly true as well. Undertaking this analysis and discussion, I wouldn't assume that there's going to be a difference in returns, right? I don't think that's correct. I think if you do the property investment properly versus the share investment properly, that the headline returns, you've got to make the assumption. I think all the evidence should suggest you should make the assumption that the returns are going to be equal. So over the long run, maybe 8 to 10%, either in the share market or the property market. So I wouldn't subscribe to that. But if you do overlay the gearing, of course, over a 20-year period, particularly 20-year period, you'll be much better off with property. Like, that's just the maths. And if it's a little bit of hassle along the way in terms of answering 2 emails from the managing agent each year, I think I'd be prepared to make that sacrifice in order to get those higher returns. But it's not property, it's gearing that's generating all those returns, and much, much higher gearing. Yeah, so I think that answers part 2. So part 3 then is, I'm 44 and my wife is 52. She doesn't need to work and can access super at age 60, which is 8 years. The property would tie up all our spare cash flow and would limit super contributions to 30,000 each per year. With shares, we could use the 60,000 of savings capacity mentioned above to boost her super materially over the coming 8 years, plus shift the portfolio equity into her super as she nears 60, creating a large tax-free pension and recycling payments back in. How might this combination of gearing into shares and boosting her super, where it will be tax-free environment for the second half of our time frame, compared with the less tax-effective but higher growth option of property? Will it have the same benefits with the initial bigger investment? I mean, it's a really good observation, I think, that Dave's sharing. And this is why making decisions in isolation is inherently risky and you're more likely to make a mistake. I've said many times that having a long-term plan gives you context for these decisions. So we're lacking context in, I can't say, no, you should absolutely, or you need to go to the extent of gearing into property in order to achieve your goals. But you're right, Dave, if I could, for example, develop a strategy that saw you gear into the share market, gradually move some of those, make additional contributions into super, and then gradually move that portfolio into the superannuation environment. And if I showed you through financial modeling that was going to easily work in terms of create enough wealth for you to fund retirement, versus then if I modeled a property strategy and that would work too, and maybe even generate more returns, although not really does it change the outcome. Like, you only need so much money, right? So if both strategies work, then you've got to pick the strategy that you think has the highest probability of working, that gives you the greatest flexibility, that costs the less amount of time, that has the lowest risk. And that could be what you've just alluded to, which is kind of part 3 of your question. I just don't have enough information to be able to intelligently talk to whether that's necessary. I think I could say that over the long run, depending on how long you kept the property, right? But if you kept the property for 20 to 30 years, I think I could confidently say that's going to give you the highest dollar value, between now and 30 years' time. But that doesn't really address, what happens over the next 30 years and the risk profile and the flexibility and all those sorts of things. And it's not just, that's why developing a long-term strategy isn't just about choosing this is the highest, this approach is going to deliver the highest absolute return, because if it doesn't suit your circumstances or there's a whole bunch of other things and risks that we need to consider, then that'd be silly. So, sorry, I don't know the answer to the question. The answer to the question is you need to financially model it. And if that strategy works just as well as the property strategy, then you in fact might choose that strategy or go with that strategy just because it is hands off. It's got more liquidity. It's got more flexibility in the strategy as well. So if your circumstances change, you can reduce debt. By selling down the portfolio a little bit, you can sell down 20% of the portfolio, whereas you can't really do that with property. It's all or nothing. And it is arguably more tax effective. Not arguably, I mean, it probably will be more tax effective, and I keep talking about trying to get all that money into super to maximize the transfer balance cap. So it certainly has merit. Whether you're in the position, whether it's going to work for you is a question that needs to be further explored. But thanks for your question, Dave, and hopefully that answers it. But hopefully, other people kind of get to learn something from the answer as well. Okay, tomorrow I'm going to talk about listed property REITs, real estate investment trusts, compared to direct property. An interesting sort of analysis that I did. I say it's interesting because I expected something different when I started out preparing for the episode than what I actually ended up concluding. So surprising for me. Anyway, it might be of interest to you. And if it is, until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.